Hi, and welcome to this week's market presentation. Latest news. In the latest developments, we start with Venezuela, where President Trump hosted several oil and gas sector executives at the White House, as Trump is seeking to have $100 billion worth of investments into Venezuela's oil sector. However, uncertainty remains, with some skepticism as to how much these oil companies are willing to invest in the country, given the political uncertainty moving forward. ExxonMobil CEO, for instance, said the country was, quote, uninvestable without significant market and legal reforms. Rystad Energy estimates that in order to triple oil crude production by 2040, it would require $8 to $9 billion of additional investments per year. Oil prices initially spiked on the geopolitical risk premium following the military action by the US in Venezuela, but now markets remained cautious of what the next steps will be and what future developments will bring. In the Middle East, widespread protests against the regime in Iran are raising concerns over the country's oil exports. So far, over 540 deaths have been reported, with over 10,000 arrests by the security forces of Iran. At the same time, the Trump administration appears to be considering military strikes against the country as well. Oil prices gained 6% over the Thursday-Friday period on those supply disruption fears, given that Iran is still exporting roughly producing roughly 3.3 million barrels per day, with 1.4 million barrels per day of exports as of the month of December, with China being a primary buyer of sanctioned Iranian oil. The risk has also amplified the concerns over market prices for crude oil, given the large bearish positions that are vulnerable to unwinding. Over in the US, Federal Reserve Chairman Jerome Powell confirmed that the Department of Justice had sent subpoenas to himself over the Federal Reserve headquarters renovation costs. Powell accused the Trump administration of trying to undermine the Fed independence, signaling that the subpoenas and action by the DOJ were politically motivated, as the Trump administration continues to pressure the Federal Reserve to lower interest rates further. Gold prices surged forward to $4,600 per ounce on monetary uncertainty, while the US dollar weakened versus the euro, rising from 1.162 to 1.168. Overall, we saw a significant or notable reaction from the market, given the independence of the Fed being threatened by the actions by the president. As the term for Jerome Powell will end this upcoming May, a lot of questions surrounding who will replace him and what their actions will be as chairman of the Fed. Lastly, moving over to Europe, the far-left Vulcan Group arson attack on power cables near the Lichterfeld plant in Berlin led to the longest blackout in Berlin's post-war history, with over 100,000 people without power for 5 days during extremely cold temperatures as low as over 10 degrees below freezing. The arson attack and the ensuing blackout has certainly highlighted the vulnerability of European energy infrastructure to both foreign and domestic terrorism. It has certainly reinforced the view for critical infrastructure protections and additional investments for the security of the grid. Weather. Moving on to the weather forecast, we know temperatures across most of Western Europe still forecasted to stay slightly above average temperatures, particularly through the middle of this week. By the beginning of the following week, however, we're going to start to see some below average weather starting to seep into Western Europe, with the majority of Northern and Eastern Europe seeing below average temperatures over the course of this week. Precipitation is expected to intensify around the North Sea, with the Nordics expected to see additional precipitation over the following 4 to 6 days before easing off at the beginning of the following week. Wind speeds are also expected to pick up across much of Europe, potentially signal additional wind power generation output. Microeconomics. PMI figures were released for the month of December for some of the main economies we follow. Most importantly, we see the Euro area composite PMI decreased by 1.3 points to 51.5 at the end of December, with the US PMI similarly decreasing to 52.7, showing some weakness over the month of December. Taking a closer look at the PMI split, we see that the biggest drag on the composite PMI figures was the service sector, resulting in the slight decrease in overall PMIs and highlighting some of the potential weakness that we could see in the European economy moving forward. In terms of inflation, China released inflation figures for the month of December, which showed a further increase in year-over-year inflation to 0.8% as of this past month. This is the highest figure that we've seen in well over a year, and certainly a positive move as China continues to be pressured by the inflationary conditions. Crude oil and LPG. Moving on to crude oil markets, crude oil prices rebounded, as we mentioned earlier, largely on the back of the news in Iran threatening their significant oil exports, particularly to China. Nonetheless, we still see oil prices on the lower end of the range that we've seen over the last few years, as we're still expected to see a significant oversupplied market throughout this year. Goldman Sachs, for example, predicts that we'll see the oversupplied nature of the market peak in the first half of this year, and that we'll see that gradually ease towards a more balanced market throughout the second half of 26 and into 2027. Natural gas. Natural gas prices across Europe saw a drop over the past week, with the forward year for 2027 decreasing by just over 4% on the week in what has been a continued bearish price evolution on the market. For the remainder of 2026, we've seen similar downward pressure, with the fourth quarter coming down 3% on the week. The downward pressure in the market comes amid the fact that storage levels have moved further below previous year's levels, with storage levels ending this past week at just around 55% full. This has once again widened the deficit versus the previous year, which has now widened to around 12.5 percentage points as of the end of this past week. Net withdrawals from storage through the beginning of the year have been near 6-year highs, and that has been largely due to the colder weather that has increased total demand quite noticeably, particularly over the past week. Total supply, which has seen a slight increase versus the previous year, remains near the bottom of the range over the past 5 years. The European gas supply mix remains highly dependent on Norwegian gas flows and LNG imports. LNG sendouts over the past week reached a new 5-year high on the back of the spike in total demand across Europe. Global LNG export destinations have seen a significant increase or notable increase in the share to other countries. And when we look at Europe specifically, we see this share in line with what we saw over the past couple of years. Most noticeably, however, is the lower share or significantly lower share of exports going to Asia, primarily as we have seen a notable decrease in exports going to China, as China has been able to supplant some of those exports with sanctioned Russian LNG from the Arctic to terminal. Overall, investment fund positions remained in the net short territory, although a little of stability over the past week as markets certainly assess future market conditions. Coal. Looking at coal markets saw limited movement for the front year, both in Europe and in Asia. Over in Europe, the cold weather of the past weeks certainly adding some support to demand and consumption from the power sector and industry, although the overall outlook remains bearish given the still ample ARA coal stocks in Europe. Over in Asia, Indonesia appears ready to start reducing overall coal exports given the weaker pricing that we see. And we've also seen signals of increasing domestic production in China as they look ahead to their supply through the remainder of the winter, adding some downward pressure on global coal prices as well. EU and UK emission allowances. In terms of European allowance prices, we note the very high price level that we're seeing in both the European and UK markets, above the 90th percentiles at historically high, certainly compared to the last few years. Carbon emissions from the power sector have certainly jumped up over the past week on the back of the surge in demand due to the weather and the fact that that demand has been mostly met by increases in fossil fuel power generation, increasing overall emissions. Overall, investment fund positions continue to hold a bullish view of carbon allowance prices, in large part due to the expected tighter supply and demand balance through 2026. In the latest auction, for example, we saw significantly more buying demand than supply, adding weight to the bullish sentiment that we see there. Over in the UK, as we've mentioned in the past, the ongoing talks for linking the EU and UK carbon markets, adding further bullish pressure to the UK market. Electricity. Moving on to electricity prices, here we note limited movement when we look at the forward curve over the calendar products, with the frontier moving just 0.2% upwards versus the previous week. A little more movement when we look at the quarterly prices, with the last quarter of 2026 moving up by 0.6 percentage points and the first quarter of 27 up 0.8%. Overall, we're still seeing a more neutral price evolution across Germany, and that is spread across much of Central and Western Europe. The exceptions continue to be the Iberian Peninsula and France, which have seen a more bearish price evolution due to the different power mixes in each country. Looking at total demand and residual load, we note that sharp uptick in total grid demand, very much as a result of the lower temperatures and increasing demand for heating. French nuclear power generation remains near the top of the range over the past 5 years, although easing off from the highs that we saw at the end of 2025. Nonetheless, the strong performance of the French nuclear fleet continues to be a bearish factor for French power prices. Renewable power generation, while remaining at the top of the range over the past 5 years, has not seen a significant enough increase to fuel the increasing in total demand. As a result, we've seen a noticeable jump in fossil fuel power generation over the past week. In terms of renewables, we note an increase in hydro reservoir generation, improving the overall renewable output, while both wind and solar generation saw more minimal movement over the past week. Fossil gas generation saw the biggest increase in total output, reaching a 5-year high for this time of year. A similar increase was felt across coal power generation, with an increase week over week, although certainly muted in part by the high carbon prices and low gas prices, limiting any gas to coal switching or additional demand for coal versus gas. Lastly, looking at the guarantees of origin, we see a bearish price evolution across the forward years, with pricing decreasing across the board. Overall, guarantees of origin pricing remains near the lowest levels we've seen over the last 18 months, in part due to the improved renewable energy outlook as we look to this year now. That covers this market presentation. Thank you for joining.